Hello everyone, welcome to Best of Us Investors. We as a tribe are gathering in the Discord server, where we share Carrie's portfolio, Carrie's buy and sells in real time, and we have live discussions every Mondays before the market opens and right after the market closes on Fridays in our voice channels in the Discord server. And of course, we share insights on stocks before the videos are released. The stock analysis team also analyzes stocks based on the votes from the tribe members. So hope to see you all in the Discord, where the link is listed in the description to join. We would also appreciate if you can subscribe and hit the like button, which will help our stock analysis videos. Now let's get started with our stock for this week. Today, we will be talking about Twilio. The ticker symbol is TWLO. Twilio is a cloud-based communication platform that offers a B2C, so business to customer solution, improving the way businesses communicate with their customers and vice versa in the United States and internationally. If you think about it, businesses these days have customers all around the world where they are mostly communicating online. So it's very important that businesses have availability for online customers. Also, there are so many channels regarding online communication, such as social media, video, and telephone services. And therefore, there's a huge demand or need for these companies to have a one application or a one place to go platform that connects all these channels. And this is where Twilio comes in, combining all the communication channels in just one solution that is available for everyone. Twilio's main products are for messaging, such as texts, emails, voice, and video applications. They're also for authentication and security, and for device connectivity, building a broad network. To get a better idea, let's look at an example. When you see an advertisement on Instagram, Facebook, or whatever SNS platform, and you click on the link, you get to the website and can purchase the product. Once the purchase is done, you get a receipt through an email, text, or a Facebook message. Now, if you look at this process, you went to Instagram, Facebook, or any SNS platform that had the product advertisement and got directed to the website, which is a third-party company. Then when you get to payment, you again usually get directed to another third-party payment company. And once your purchase is done, you get a receipt through a phone, text, email, or Facebook Messenger, which is again also another third-party company or channel. Twilio is the platform where all these services are combined, and they are trying to communicate with the most comfortable way that the customer is already used to, such as, again, text messages, emails, phones, videos, and intelligent chatbots in the US and internationally, in order to increase the engagement between businesses and customers. Even before the pandemic, I personally think this was a trend for customer communication becoming digitalized. And I don't think customers these days, especially the millennials and Gen generations, want to spend like 15 to 20 minutes over the phone waiting for a rep to answer their questions, but would rather, for sure, I think, ask through a text or an app like Facebook Messenger or WhatsApp and get their answers right away. After the pandemic, online communication has become even more important, since the majority of people don't want to leave their houses to be safe and want stuff to be done electronically. And this is exactly what Twilio is providing as a solution. Now, Jeff Lawson is the CEO and is also the founder of the company, which I usually like to see, since this company is like his baby, and he will put all his efforts to make the company successful. If you look at their clients, they grew from 60,000 in 2017 to more than 230,000 active customers as of June 30th, 2021. This is including companies such as Lyft, Airbnb, Shopify, Uber, Netflix, Wix, Twitter, and they also have partners with banks such as Morgan Stanley, LendingTree, TransferWise, and ING. Twilio is also in 3 of ARK Invests ETFs, ARK W, ARK K, and ARK F, and is actually the 9th largest position in ARK's combined whole portfolio. Now, if you look at their ownership, about 80% is owned by institution, the smart money, which is something I really like to see in companies that I'm interested in to invest. As of now, I do not have a position in this company, but I definitely think that it has a huge potential to exponentially grow in the upcoming future.
So talking about the cons and the risks of Twilio, the operating expense is pretty high, which is making it a non-profitable company. That's number one big thing I see. They're not making any money for the company, for the shareholders. With the operating expense being high with 1.8 billion, and the revenue is actually increasing and the gross profit is also increasing, but the operating expense is also increasing substantially, which is making it a non-profitable company. So with the operating expense at 1.8 billion with a gross profit of 1.1 billion, with that it makes the operating income of negative 697 million, which is making it a non-profitable company. So they're not making any money for the business. Twilio is currently trading below the 50 MA, which I would not recommend buying under the 50 MA if you're looking to hold short term for like a swing trade or something like that. Since it's below the 50 MA, that is currently a resistance line, and I would definitely wait for it to reclaim the 50 MA. And it's almost just over it, but I would definitely still wait for it to reclaim the 50 MA, just in case it just bounces down after touching it. That is one risk to look out for, as it's below the 50 MA. And the other thing is that on the monthly chart, Twilio is close to overbought at around 64 to 65 on the RSI. So anything over 70 is considered overbought. And whenever the stock on the monthly chart has gone overbought, it's been followed by a pretty big downtrend. As in the past, it's done that twice. And currently it's around 64, which is also still a pretty high RSI. You have to watch out just in case it does go over the 70 mark on the RSI and it does become overbought. And it might even take a downtrend from here because 64 is still decently high. So that is one risk to look out for on the monthly chart. The other thing is that the forward PE for Twilio is super high at around 4,631. So the stock is trading pretty high for a company with no actual money. They're not making money. They're not profitable. And the forward PE, when they do become profitable, is around 4,631. And that is a super high forward PE. That is with the con on the partners. Twilio partnered with Cineverse, and Cineverse is a global company that provides technology and business services for a number of telecommunication companies, which Twilio is one of them. The companies both signed an agreement where Twilio will invest up to $750 million in cash in Cineverse, and it will become a significant minority owner of the company. And the Carlyle Group, which is Cineverse's current majority holder, will maintain its majority interest in Cineverse, but with Twilio just taking a significant minority ownership of the company with this $750 million investment. The second partnership that they have is with Well Health. Well Health is a platform where people in the healthcare industry can communicate. So it's basically like Twilio, but it's working in the healthcare industry for telecommunication. They recently partnered both of the companies, Twilio and Well Health. And so with the partnerships with the healthcare providers, they're going to be offering them two leading options for patient engagement, with one option being Twilio service and one option being Well Health service. So they're just kind of making this like mutual connection with the healthcare industry. And at a time when the need to communicate with patients securely and quickly is pretty critical because of the COVID-19 pandemic, two leading options and this like connection between these two communication companies is pretty good. So those are the two main partnerships that I see Twilio going around with as of now.
So right off the bat, what I like to see about Twilio is that their R&D expenses keep increasing. They are investing heavily into growth. And another thing I like to see about the company is that they keep beating earnings estimates. Lastly, I really like how much cash and cash equivalents they have, especially when you compare it to their competitors. They really tower above their competition in this department. Going further into the competitors and how Twilio compares, I'll be looking at and comparing Twilio to Bandwidth, ticker symbol BAND, Avaya Holdings, ticker symbol AVYA, and Vonage, ticker symbol VG. Vonage and Avaya also offer other services next to their communications platform as a service, or CPaaS, so it's not 100% accurate, the comparison. Bandwidth, on the other hand, is the most similar to Twilio of the competition. So first off, if you look at the price to sales ratio, you'll see that Twilio's PS ratio is the highest, being 28. This means that they are kind of overpriced. However, their sales keep on increasing drastically, so that may be part of the reasoning for why there's so much hype behind the stock. Plus, over time, if they keep drastically increasing their revenue like they've been doing in the present, they'll make up for that high price to sales ratio. Avaya has a staggering PS ratio of 0.6, which is weird to see. Regarding price to earnings ratios, most stocks here have a negative earnings, save for Avaya. They have a PE ratio of 97. Something to note about this company, Avaya, though, is that they tend to swing around profitability. Sometimes they turn a profit and other times they don't. They're lacking stability, but otherwise the stock doesn't look half bad. And some may say that they're undervalued. It's an interesting stock to look into. Twilio's price to book ratio is around a 7.5. What I like about Twilio here is that they have very few liabilities relative to their assets. They have about 9 times more in assets than they have in liabilities. The competitors don't share this quality. Most have around half in liabilities to what they have in assets, and Avaya, which has almost as much in liabilities as they have in assets. Regarding R&D expenditures, as I said, I like how Twilio keeps investing heavily into growth. Even though because of their large market cap, they seem to have a high price to research ratio. Still, they spend loads more on R&D than their competitors. And every year they spike up their R&D amount. A competitor that does come close though is Avaya. They spend almost half of what Twilio spends in R&D. Lastly, all the stocks seem to have pretty sad operating ratios, all being around 1.
Yeah, I'm sitting at the lake today, so there may be some distractions running around, cars going by, whatever. So it's a nice day. So we decided to come outside and look under the hood for Twilio. Let's look at the condensed consolidated statement of operations over the last 3 years from 2018 to 2020. You can see the revenue's gone from 650 million in 2018 to 1.7 billion in 2020. So it's always good to have increasing revenue. And then the gross profits you can see also have gone from about 350 million to 915 million. Unfortunately, the operating expense has also increased dramatically to 1.4 billion in 2020. So that takes the gross profit and leaves you with a loss from operations of $492 million. And when you get down to your net loss, it's $490 million or $3.35 a share. And you can go back 3 years and see that it was a $1.26 loss in 18, $2.36 in 19, and $3.35 in 20. You can see the shares, number of shares went from 97 million to 146 million in those 3 years, meaning that if you're a shareholder, your shares are being diluted underneath you. This is from the 10Q, which is a quarterly report. The 10K is for a year over year. So for the 6 months ending June 30th of 2021, you can see basically revenue has gone up to $1.2 billion from 765 million from the year before. Also gross profits, 629 million. But where we get into the problem from my point of view, is the operating expenses have also increased to just a little over $1 billion, leaving you about $400 million of loss from operations. The net loss total is $434 million as opposed to $194 million, or $2.55 a share for the 6 months as opposed to $1.39. So you can see it's a growth company. It's not making any money. They're losing money. There was 146 million shares at the end of 2020. Now we have 170.2 million shares available, and the company has authorized 1 billion shares to be available if they need it to finance this company. So that's 1 billion with a B, 9 zeros after the 1. So that is a flag for me because it just says my shares could be diluted even further from 170 million to 1 billion. So that's definitely a bad sign for me. So when we're looking at the balance sheet, you can see that they have a lot of cash on hand, about $1.8 billion in cash, which is really good. Their current total assets is about 6.3 billion. When you look at the total liabilities of 583 million, that's well more than enough to cover their expenses on the short term. So that's always a good sign on a balance sheet. In March of 2021, the company issued $1 billion of senior notes, 500 million at 3.625%, which are due in 2029, another 500 million at 3.875%, which are due in 2031. So the net proceeds out of that came up to be $985 million. So you can see that is how they're financing this company so far, through notes and offerings. So when we look at the liquidity and capital resources, basically the principal source of liquidity have been the net proceeds of the $979 million, 1.4 billion and 1.8 billion net of underwriting discounts and other expenses from their public offerings in June of 2019, August of 2020, and February of 2021. The net proceeds of approximately 537 million after deducting purchaser discounts basically is what they're saying is this is how they make their money, is through these notes and offerings. So they believe that their cash and cash equivalents, marketable securities, balances, as well as the cash flow generated by their operations, will be significant to satisfy their cash needs and working capital and capital expenditures for at least the next 12 months. So you've got that going for you, 12 months. When we look at cash flow from operations in the 6 months ending June 2021, cash provided by operating activities consisted primarily of a net loss of $434.4 million adjusted for non-cash items, including $281.3 million of stock-based compensation expenses. So there we go again. These new companies, stock-based compensation, all the directors, the original owners and executives are all being, in my opinion, rewarded prior to the regular shareholders. So just be aware that that's out there, and that's going to cut into your profitability for who knows how long in the future. So after they've gone through, done their voodoo on the money, you can see cash from operations, they come up with a positive 26 million off of $434.3 million in net losses. So when we go down into cash flow from investing activities, in the 6 months ending June 30th, 2021, cash used in investing activities was 2.2 billion, primarily consisting of 2.1 billion of purchases of marketable securities and other investments, net of maturities and sales, 94.2 million of net cash paid to acquire other businesses, so they're acquiring businesses, 21.8 million related to capitalized software development costs, and 12 million related to the purchase of long-lived assets. So they are investing back into the company. When we go down and we look at cash flow from financing activities in the 6 months ending June 2021, cash provided by financing activities was 3 billion, primarily consisting of 1.8 billion in net proceeds from their public equity offering, 986.1 million in net proceeds from the issuance of their 2029 and 2031 notes. So again, this is where their money's coming from. It's not coming from operations, and I don't see in the near future that that's going to be changing. So when you get down to it, net cash and cash provided by financing activities was a little over $3 billion. Okay, see, we're going to look at the financial summary of things that I look at, basically, including revenue, which is increasing, which is a plus to me. Unfortunately, their loss from operations are also increasing. We want to see positive gains in operation. We want to make sure that the money that we make in operations covers our expenses, and that's not happening. The net loss is increasing, which is a negative. Our per share earnings are negative and growing is a negative to me. Number of shares are increasing year over year, and you can see they're up to being able to authorize shares to dilute us retail investors even further. A balance sheet is a positive on the current assets being greater than the current liabilities, so they can cover their short-term liabilities. Stock-based compensation is increasing, which means that other people within the company and the owners and the executives and directors are probably going to get a lot more money than a regular retail shareholder in the near future. In liquidity and capital resources, most of the cash is provided by offerings and notes, not operations. So they're going to have to dilute you further as a shareholder to keep this company rolling unless they get profitable, which I don't see in the near future. Now, this is all to do your own due diligence like I do. These are things I look for. Now, I'm more of a value investor. If you're a growth investor, and which is fine, everyone has their own way of investing. Do your due diligence. Look for a good entry point if you really want to get into this company and hold in dollar cost average in, and good luck.